This is Robert Kraft, and I'm your host on SNN.Network. And with me today is Chris Irons from Quoth the Raven podcast. You can find him at Quoth the Raven on Twitter. Frequent guest on here. I've had him on the podcast and whatnot. And I thought with a day like today, nobody better than to bring on the Raven himself to talk about what the hell happened. So, Chris,
So,
welcome
man,
back, man. How you doing?
I'm doing great. I'm sorry I look like a little bit of a degenerate today. People that are tuning into your channel for advice on the financial world and see me sitting here in my pajamas, with my tattoos hanging out, are going to be wondering what kind of show it is you're peddling, and be like, "What dumpster did you fucking get this guy out of?"
Well, you know,
I didn't
well,
have time. I didn't have time, Bobby. I was upstairs. I just did a podcast myself with Peter Schiff. I
mhm.
was like super busy today, so I just had to rush down here real quick. But I'm stoked to be on with you.
Well, I was going to say normally when we have you on, but it's usually audio only, that's when you're in your button down. So we thought for the video portion today, we're going to
Oh
do the
yeah,
tank, show the tats, and just say, that kind of thing.
I always wear suits for my audio podcasts.
Yeah, yeah, right. So before we get into all the news from today, because we got a lot to cover, for those who don't know, tell us a little bit about your background and what you got going on at Quote the Raven.
Well, my background is that to give you the abridged version, I started looking at the financial markets when I was 18 years old. Didn't really know shit about shit. Lost a lot of money trading stocks, options, forex, you name it, everything. Was just the world's worst trader, and I was always interested in the markets. I went to go work for I was working at a bar at the time when I was doing graduate school. Eventually went to go work for a startup company, wound up running their investor relations department and implementing their entire IR department from the ground up. So learned my way around SEC filings, securities attorneys, CFOs, CEOs, all that stuff in the nitty gritty details because it was a small operation. So I was part of a team of like 3 or 4 guys that would write the annual filings and stuff like that. So a little bit of baptism by fire there when I started there without real experience. And then from there, that kind of dovetailed into learning actually how the capital markets work, how all the financial markets work, whether it's, debt markets, equity markets, bond markets, currency markets, whatever. Learning about this central bank charade that's going on. And then from there, I went to go work for a company called Geo Investing, which was a company that was instrumental in exposing over $10 billion in U.S. listed China-based fraudulent companies. I worked for them for 5 years doing research and analysis, and I was their senior business writer. So, worked on almost everything that left the building at Geo, just trying to help expose people that were ripping off average, ordinary Americans. They made a movie about Geo while I was there called The China Hustle about Dan David, who I worked with, which is a great film if you can check it out. You, of course, know Dan's partner, Maj, because he's a huge microcap investor. So I got, a little bit of the short world there, a little bit of the microcap world. And then the whole time been kind of writing under Quote the Raven and tweeting under Quote the Raven going back almost 10 years now. And you can see in my writing and in my tweeting as I'm kind of going along, I'm learning the markets. My shit from 10 years ago is terrible. I'm embarrassed to read it. But I like the direction I'm heading. I think I have a pretty good learning curve. I started a podcast last year. For those that don't know me, I'm a market skeptic. I'm a central bank skeptic. I kind of align myself with the Austrian school, sound currency, no deficit spending, saving money, shit that we don't do anymore. I just kind of consider that common sense, being where I'm from and the household I was raised in. Started doing a podcast because I didn't really hear anything on the financial media that I wanted to hear. Today, for instance, the Dow was down 800 points, I think, when I left upstairs. There's one guy that called the 2008 recession on network television that I saw, and that was Peter Schiff. And I called him up today, figuring major news networks would be inundating him with invitations to go on the air, and he's sitting around, doing nothing today. He's like, no, I haven't gotten a call from anybody. So bears are not welcome on network television, and that just means that the dipshits really is the word that I'm looking for in the mainstream financial media who are sitting around kind of looking for a clue as to why today happened are not getting themselves anywhere closer to that. So you may have known me from any of those things. You probably don't know me at all. Unfortunately, this is what I look like if this is the first time you see me.
Oh man. Well, so you already hit on some of the main reasons why I hit you up today, because I mean, from the tariffs to China lowering the yuan, I mean, there's so many potential reasons for why today happened. Last I checked, you mentioned it was around 800. It closed today approximately at 767 points down. At one point, it's down about 900 today. We're talking about the Dow. Gold was up. It almost hit 1,500. Even cryptos were going nuts. I mean, so what's your take, man? What happened today? Why did this day happen, which is being dubbed the worst trading day of 2019 so far?
Well, it's the worst trading day if you're a long-only investor, and you're indexed in your Vanguard or Fidelity 401k, and all you own is index funds. It's a shitty day for you. If you have a portfolio of gold mining stocks like Peter Schiff does, or if you're like me and you're long some equities, but you also own a lot of gold stocks and foreign stocks, things that are kind of not clumped in with the Dow or the S&P, today wasn't the worst day. For people that don't know any better and think that you can only be a long investor and just go out and buy garbage companies with garbage balance sheets, and, recent IPOs and things like that, it was probably a shitty day for you. There's a multitude of reasons that today happened, right? So the kind of match that lit the fuse today was the escalation of the trade war tensions between Trump and China. And but I think that's just a symptom of a bigger problem. I think today's sell-off was a symptom of a bigger problem. And this is actually what Peter Schiff was just saying on my podcast moments ago, which is the main problem as I see it right now is this. The theory that we constantly need to be stimulating the markets, the kind of Keynesian nonsense that we can print as much money as we need and we're going to be able to stimulate ourselves out of every recession, to me, is just plain wrong. We may be able to put off recessions, but ultimately the market always wins and will correct itself. And what that means is that at some point, we're not going to be able to stimulate ourselves out of a recession. Either the market will lose confidence in the Fed, which would be disastrous, or the Fed is going to print so much that it's going to cripple the dollar. And like you said, gold was up today. I don't think it was near 1,500, but I think it was up at its high about $25 to 1,480. And Peter Schiff said something great on my podcast, which is you can look at that as gold rising and going up in price, or you can look at that as the dollar weakening against gold, which is really what it is, right? So if gold's measured in US dollars and the price of gold goes higher, that means the value of each dollar is lower, right? So when you're trying to buy an ounce of gold. So we have a much larger problem at hand, which is the more that we try to stimulate ourselves out of these little hiccups in the market, the bigger we're creating the bubble that we're in right now. And people don't know it, but the levels of debt that we have right now, whether it's student loan debt, mortgage debt, consumer debt, subprime auto debt, are all reaching levels that are getting close to where we were pre-2008. I was reading this morning that I think pre-2008, about 13% of household income went to servicing debt. And we're at about 9.9% now, or 10% now. And we're moving in the wrong direction. We have the middle class has taken on a significant amount of debt. And the job market holding up has been one of the only things that has allowed people to kind of continue to service this perverse debt load that they have. So when job cuts start happening, which will be an inevitability when we do hit recession and corporate earnings start to fall and layoffs happen and the job market gets a little bit worse, people are going to have a lot of serious trouble servicing their debt. And that's when we're going to start seeing write-offs, charge-offs, et cetera, thus begins the cycle in the other direction. We start to see deleveraging, prices start to go down. We're not that far off from it. Whether today was a reaction to people understanding that larger picture, I'm not quite sure. I think people were scared a little bit about the trade war escalating.
Mm-hmm.
I think that people were expecting a 50 basis point cut from the Fed, which is really fucking sick when you think about it. The fact that the market's at all-time highs, and here we kind of randomly cut 25 basis points, which we don't need to do. And even on the day that Powell cut and then stood up there at the podium and was like, he didn't even know what he wanted to say. We're going to make more cuts. We're going to make less cuts. And it was like he was sitting there like watching a chart of the S&P, just like panic trading while it was happening. Like, buy, sell. We're going to raise. We're going to lower. Like, it was ridiculous. And Peter Schiff just said something great, which is like he contradicted himself, which is what people do when they're lying, right? So the market didn't buy into that, his idea that this was a mid-cycle adjustment. What the market wanted to hear was this is going to be long-standing policy that we're going to continue to ease. And the crazy thing is the further south we go with rates, and they will eventually go back lower, and we will eventually start QE again, what people don't understand is we're kind of embarking on a journey here that we've never gone on before. We've never been here in terms of monetary policy before. It's going to come to a head at some point. The market is going to win at some point, and it's going to do what it wants to do. On my podcast a couple days ago, I said it's like plugging a hole in a dam. If you plug one hole, all of a sudden the water starts coming out of another one. Mm-hmm. And if you plug that one, the water starts coming out of another, until at some point the wall just gives way and the dam breaks. And that's what's going to happen eventually at some point. I don't know what the catalyst is going to be. And I don't know when it's going to happen, but I do believe the dollar will weaken significantly. Mm-hmm. And I think it's an inevitability that, the sooner we come to realize that, the better off we're going to be. Mm-hmm. I have no confidence that we will come to realize that based on what I see here on CNBC and what I see elsewhere in the financial media, and the fact that the only person in the entire financial world that went on the mainstream media and called out the 2008 recession is slumming it on my podcast and is not on national television somewhere.
So this might be a dumb question, but
sure.
I'm going to ask it anyway. Why don't they just let the dam fall? Haven't we learned from past mistakes? Just let it break, build up from there. Why is that? For those who may not know some of these short-term implications and then having that long-term view of what some of these things might happen.
It's the same reason that the Fed won't come out and say that they're forecasting a recession. Now, you could argue they do that for two reasons, right? One is they're idiots and they actually don't forecast a recession, which I kind of believe, unfortunately. Mm-hmm. The second is maybe they do forecast a recession, but they don't want to come out and be the match that lights the fuse in the other direction there. Mm-hmm. And it's like I said in my presentation at Case Learning called "Short the Whole Fucking Thing." It was a presentation about buying. It was a presentation about buying gold to short the whole system. Mm-hmm. Right? It's on YouTube. You can check it out. But what I said there was, it's herd mentality. Nobody wants to be the first person to come out and say that. Yes, it's unpopular news, right? So it's like politicians don't like to give their constituents unpopular news because it doesn't get them reelected, and it kind of makes everybody agitated and pissed off for a little bit. And especially nowadays, the culture that the United States is in, this kind of snowflakey kind of, everybody's got to feel good all the time. Everybody's got to be comfortable all the time. When the fucking reality of markets is sometimes shit sucks. Sometimes things suck. Sometimes you got to pull yourself up by your bootstraps, and that's when you want to have savings. That's when you want to have equity and all the things that we don't have from encouraging our spending from a deficit position right now. Mm-hmm. So the fact of the matter is that that dam will break at some point, and that's why things like 2008 were so catastrophic, mm-hmm. because when things started to go in the other direction, the average family didn't have shit saved up. They didn't have equity in their homes to fall back on. Mm-hmm. The same thing's going to happen, right? So it's a question of whether or not, we would be able to handle somebody delivering us the bad news, either in a way where they tell it to us and we just got to listen to it and then process it, or it actually happens to us, which will happen. And we don't like it. We don't like good news. We don't like taking the medicine, even if it's the tiniest bit of medicine. I mean, Bobby, we were down 800 points today on the Dow. Right now, if you look at a chart of the Dow over the last 30 years, you might as well. I mean, we look like we're at all-time highs because we basically are, right? And people are on TV today shitting bricks like the world is ending. It's like we're 3% off highs. Like this is totally normal. And I always say, markets are supposed to go up and down. Gasoline goes up and then it comes down. It goes up and down and up and down and up and down. It's not like the price of, crude oil has constantly gone up nonstop like the stock market has. You can make a little inflation argument there, but the principle of the point is that, when you have a market that only goes up, why would you be surprised when it finally takes a breather and comes down? Even though we're fanning the flames and we're rigging the whole thing, why are you surprised when it takes a little 3% breather? This is what you should be preparing for when the market's going up, and then when the market's on its way down, you should be considering where you would want to reposition yourself again to the long side, right?
So then what is the Chris Irons quote the Raven guide to how do you prepare for when you see the market continue going up and then days like today? How do you get prepared for things like this?
I don't give financial advice. I'm not a financial advisor. So,
how do you get prepared? How about that?
I'm not giving people advice to do anything except try to fucking open their brains up, turn off CNBC or even listen to CNBC, but then also go out and listen to alternative points of view too. So you can kind of view the broad spectrum of theories and ideas, and you're not just under one umbrella. So when somebody asks you if you're diversified and you say, yeah, I'm in stocks and bonds, and they say, yeah, but everything's dollar denominated, you're going to be like, oh, what does that mean? There's a different type of diversification. Just try to open your mind a little bit and embrace the fact that we're on an unprecedented experiment right now. And personally, how I deal with it, look, I have a portfolio of long-only dividend stocks, right? The Warren Buffett strategy, whatever, because I'm not super stoked about fighting the central banks, even though I do eventually think it's going to be a shit show, and their theories will be proven to have been worthless. So I do own some stocks on the long side, but a lot of what I invest in, and I do have a short book too, so I have some names that I'm short that on a day like today obviously perform extremely well, and these are mostly equities with terrible balance sheets that aren't generating cash and aren't generating a profit. But also, I own a lot of gold. I own a lot of silver. I own gold miners. I own the GDX. I own the GDXJ. So really, like on a day like today, when the market, quote unquote, crashes, my short book and my gold position and those types of things offset kind of what I lose in my long book. And if you're asking for my outlook looking, decades forward, I like to own gold and I like to own silver because I think that barring any major massive change in the supply of gold, like, the asteroid hitting the Earth that's got $10 trillion worth of gold on it that they say, barring that.
It just missed, by the way.
Yeah, barring that, gold is really the only real money. And measured in dollar terms, as the purchasing power of the dollar continues to move lower, gold will continue to appreciate. So I think during times of panic, gold prices in a little bit of a premium, but I think it does a very good job of wealth preservation also, too, if you're a believer that the system is kind of fucked and that the dollar is fucked over the course of the long term. So, if I could only buy one thing and only hold one thing for the rest of my life of any asset class anywhere, it would be gold. That's not the case, so I own a whole bunch of stuff.
Got it.
Because, I find little individual equities here and there, companies with good balance sheets that I think are acquisition targets. So I think, I can make maybe 20 or 30% here in this equity over the course of a year. And the equities that I short are companies that, I know will have to raise cash, or, there's something fraudulent going on, or there's some type of red flags. So I kind of pick and choose those individual long and short spots. The stocks that are in my long only portfolio, I have some microcaps. They're, for the most part, kind of immune to these big market moves, for the most part. smaller companies that I think have huge growth trajectories, companies that, I know Maj really likes also too, and has probably talked to you about. And then I own, a lot of staple stocks that I think are going to be around for another 100 years. And really I'm just looking to get yield from them. So I'm buying some energy stocks now that I plan on holding for a long time because I can lock in a 5%, 6% yield on some of them. And I know that they're not going away. But that's it, man. Gold and silver really they're my two favorites. And until the Fed shows me that they can at least give the impression that they have their shit together, which they haven't, and I know they don't, that's not going to change.
So I just did an interview with Rick Rule. I'm sure you know Rick, a big gold speculator in Sprott. And we talked about Black Swan events. And,
but I know Ross.
You know Rick Ross? Oh, okay. Well, he was like
the real Rick Ross.
Well, what we were talking about was Black Swan events, and for him, his whole thesis is that with metals, doesn't matter when it's happening, if it's happening, but it's still interesting to kind of talk about. Now, some people might say or look at today's news with the tariffs and the lowering of the yuan as maybe mini Black Swan events, or to some who don't know, they see just 800 down because of that news. That is a Black Swan event, but in your opinion, what do you think is, or your take on what could be a potential Black Swan event that can continue to see these, big sell-offs like this in the future?
The biggest thing is a shift in psychology and a shift in sentiment and a shift in the way that central banking is viewed, right? So we already see it a little bit with Bitcoin, people kind of doubting the Fed and doubting this new Keynesian theory, modern monetary theory, all this nonsense. People are starting to become a little bit more skeptical of theory, the way that it's being implemented. People don't know that there's a couple different schools of theory that we could be from, and we're just kind of operating under this one. Any bigger kind of public realization of that and shift in sentiment about the way that central banks worldwide are running policy could be a huge Black Swan event. I think it's an inevitability. I think it's just a question of when. And we have a globe full of fiat currencies all kind of running the same nonsensical policy. It's just a matter of time. And even though the world central bankers pretty much just jerk each other off and say, like, hey, we're all doing the right thing. We're all, we're happy with the way EU's running policy. EU's happy with the way the US is running policy. But they're really both doing the same thing. They're both trapped in this low rate box that nobody can get out of. And so they just kind of walk around and say, isn't everything so great? Nervous laughter. That'll stop at some point. I don't know if it's 5 years from now, 50 years from now, 500 years from now, but it can't go on forever. And now with going into negative rates, we have no clue what we're doing. We have no idea what we're doing. And so we will reap consequences that will be much larger than, much more profound than anything that's happened to us in the past. And that's, I'm not an economist, okay? I'm just a person that's applying common sense. And economic common sense is what? It's supply and demand. It's, it's advocating for savings instead of spending. It's allowing the market to set a price for interest rates and not rigging interest rates. And it's not being arrogant, which is what the central banks are and what many people in the financial media are. I just gave a speech in June, at the end of June, at the Benzinga Traders Conference in New York City, called Perma Bears Are Not Ridiculous People. And it was a response to CNBC anchor Josh Brown's blog post that perma bears are ridiculous people. And I understood Josh's point, and I get what he's trying to say, but I think that's bad for finance when you write something like that, because first off, I think it's arrogant to assume that somebody with a different point of view than you, especially even though it's a much bigger disagreement, it's not like, hey, you disagree on what the market's doing today. You're disagreeing with policy as it happens over the course of 50 years, 100 years. So it's easier to kind of ridicule immediately. But I think that type of arrogance is what gets us into trouble. And I said at this speech, which is also on YouTube if you want to see it, it's on my YouTube channel. But I said at the speech, the only real arrogance you can have in the financial industry is assuming that you know what's going to happen and that over the course of the long term and even tomorrow, because you don't. The market will humble everybody. It's completely irrational. It's totally rigged. So it's like, who fucking knows what's going to happen? Like, this isn't the days where, like, oh, you read the soybean crop report and there's not enough crops, so the price goes up. Like, yeah, that might still happen with commodities. That doesn't happen with equities. Equities are like, Peter Schiff said today on my podcast, what's the difference between a company that has 100 PE and a 70 PE? It's like, we're just out there in fucking dream world, Bobby. And like, who cares at this point? Like, we're so far off the track. We're so many deviations away from normal that anything's a guessing game at this point. If Trump resigned tomorrow, could I sit here and tell you the market's going to go up another 1,000 or it's going to go down another 1,000? I don't know. The market might stay unchanged. You know what I mean? Like, we just don't know. So what I advocate for is keeping an open mind and trying to be humble and realize that we don't have all the answers. I think the arrogance, the central bank arrogance, is what's going to get us in trouble.
I think that's a great way to end it right there. That's, it's a good, a wise way to end it. You know what I mean? Kind of thing. But anyways, so Chris, where can my audience go and find more information about you, listen to your podcast? Just, throw some plugs out there.
It's all right. I don't do a lot of self-promotion, but my shit's out there. If you want to find it, you can find it. Bobby, it's been real, brother.
Dude, always a pleasure, man.
Yeah, man. Anytime. We'll talk soon, buddy.
All right, dude. Later.
Bye.